REITs are once again in high demand, experiencing a surge in value due to the anticipation that interest rates will return to lower levels in the near term. They surged by nearly 10% over the past month alone, and this rally really appears to have caught everyone's attention. I know this firsthand because my videos are suddenly getting more views, more people are signing up to my REIT newsletter High Yield Landlord, and I'm getting also a lot more comments now from new investors who keep asking me the same question: what are the best REITs to buy today? It's a tough question to answer because it really depends on what you're looking for. There are some REITs that are better suited for income-oriented investors. Here, Realty Income comes to my mind. Then there are some REITs that are better suited for growth investors, and a good example here will be Digital Realty Trust. But there is a small minority of REITs that check all of the boxes and could make sense for most investors. These are undervalued blue-chip REITs that offer relatively high yield, steady growth, and future upside potential. Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to discuss two REITs that I think that most investors should consider. I think that these two REITs will be a great starting point for a lot of investors to build the foundation of their REIT portfolio, because I expect them to deliver above average returns with below average risk over the long run. We hold large positions in both of these REITs as part of our portfolio at High Yield Landlord. If you want to access this full portfolio, you can join us for a 2-week free trial. I'll put a link to it in the description of this video. So the first REIT I'm going to discuss here is called Alexandria Real Estate. Its ticker symbol is ARE, and this is, in my opinion, really as close to the perfect REIT as you can get. Let's review each aspect of the REIT one by one. I'll start with the assets, then the balance sheet, the management, and the valuation, and then we'll discuss some risk factors. Starting with the assets, Alexandria is the only REIT that specializes in life science properties. So these are labs that it's leasing to big pharma and biotech companies that then use them for research and development purposes. And being the leader in this space, Alexandria has been able to build a portfolio of Class A properties in the best markets of the nation. And this is a great sector to be a landlord because of a number of reasons. Firstly, there is high and growing demand because there's always more and more money being pumped into the research and development of new groundbreaking drugs, and this is leading to rapidly growing demand for lab space. Secondly, this is a property sector with low secular risk. You know, every property sector has some technological risks. For malls, it's e-commerce. For office, it's Zoom and remote work, but it's hard to foresee a world in which we wouldn't need lab space. You cannot conduct these experiments from home. You need a lab for it, and AI cannot really replace these experiments either. So there's low secular risk in this sector. Thirdly, it's also a recession-proof property sector because the demand for lab space is not really cyclical. People keep on aging, they need healthcare services and products, whether we are in a recession or not, and therefore there is steady demand for lab space as well. Fourth, your tenant is typically highly dependent on your property because they will house millions worth of equipment in their lab, but also potentially billions worth of intellectual property, and moving all of that from one property to another is not very practical. And because of this, property owners typically enjoy consistent and high occupancy, especially if they own desirable properties in strong markets. And then the fifth reason why this is a great property sector is because the leases are typically quite strong for landlords because these are high demand properties, especially in the most desirable markets. And this is well reflected in Alexandria's leases. Typically the lease terms are very long, resulting in highly consistent and predictable cash flow. But the tenant is also typically responsible for all property expenses, including even the maintenance of the property taxes, the insurance, and so on. This is the typical triple net lease structure that we have discussed in previous videos. And importantly, they also enjoy 3% annual rent escalations, which are predetermined at the day of signing the lease. This is more than twice the property escalations of a typical net lease rate like Realty Income, and yet it still enjoys the same benefits of not having to pay any of the property expenses. As a result of all of this, life science properties tend to enjoy steady and growing rental income over the long run, and this is well reflected in the property valuations. Typically, cap rates are very low in this property sector because they're in high demand among institutional investors. Okay, so that's for the assets. Now let's turn to the balance sheet, and Alexandria really has one of the strongest balance sheets in the entire REIT sector. It has a strong BBB plus investment grade rating, a low 25 to 30% LTV. Compare that to rental property investors who typically buy properties with 60-70% LTVs. It's very conservative, and importantly, it also has some of the longest average remaining debt terms in the REIT sector at 13 years. And it also has 5 billion worth of liquidity that's waiting to be invested as new opportunities present themselves. This means that the REIT won't be heavily impacted by the surge in interest rate, and if we face another black swan like a pandemic, it also likely won't be heavily impacted by this because the leverage is so low. But it also means that the REIT is in a good position to play offense in the coming years. Okay, so far we've established that the REIT has great assets, a strong balance sheet. What about its management? And once again, the REIT is doing really well here. And in fact, the management has one of the best track records in not just the REIT sector, but the entire public financial market. It has managed to easily outperform the S&P 500, the REIT benchmarks, but even companies like Warren Buffett's Berkshire Hathaway, Walmart, and many other highly successful companies. REITs are typically relatively boring income investments, but this is not the case of Alexandria. It has been able to grow its cash flow at a rapid pace, and this has resulted in very strong total returns for shareholders. The management of the company has consistently managed to grow the rents of the REIT, but also to acquire and develop new properties at large spreads over its cost of capital, creating significant value for shareholders. Okay, so let's discuss the valuation now, and I think I've made a pretty strong case that this is a blue chip REIT, great assets, steady growth, strong balance sheet, exceptional management with one of the best track records in the REIT sector. Therefore, you would expect Alexandria to trade at a blue chip-like valuation, and this has historically been the case in most time periods. It has typically traded between 20 to 30 times its FFO, which is similar to cash flow. Its 5-year average has been 25 times FFO, and yet today it's priced at just 12 times after seeing its share price crash over the past 2 years. This crash would imply that the company is doing really poorly and that its cash flow and dividend is crashing down, but the interesting thing here is that it's not the case. In fact, the company has been growing its cash flow and its dividend steadily over the past 2 years, even as its share price crashed to lower levels. So why is it so cheap then? And I think that there are really 3 main reasons here. 2 of them that are not really warranted, and 1 is just temporary, and so I'm not too worried about them. Let's start with the first one. It's interest rates. This is quite obvious. The entire REIT sector has been in a bear market over the past 2 years because interest rates were surging. Investors were selling REITs to redeploy proceeds into fixed income investments, and on average REITs dropped by about 30%, and Alexandria wasn't immune to that. The second reason is that Alexandria is typically grouped with office REITs. Despite not owning office properties, it focuses on life science properties, which enjoy very different fundamentals because, again, you can't really conduct these lab experiments from home, so it's not heavily impacted by the surge in remote work. But even then, because there is only one REIT of this type, typically investors will group Alexandria with other office REITs, and even NAREIT, which is the representative body of the REIT sector, is grouping REIT in the office peer group. And I think that this has somewhat hurt its market sentiment because not everyone is following REITs very closely. Most funds invest in many different sectors, tech, REITs, consumer goods, and so on. And they see that Alexandria is with offices, and just because of that, perhaps they will not consider investing in the company. And so I think that this has unfairly hurt the company's valuation. The third reason is more valid, and it is that the life science space is today oversupplied. And this is what we're now going to discuss in the final section on Alexandria, which are the risks of the company. And the main risk is that, the market is oversupplied. What happened following the pandemic is that a ton of money was being pumped into research and development to develop these new drugs. Interest rates were also very low, and as a result, a lot of new property developers came to this specific sector. They started building new properties, and now all this supply is hitting the market, and it's leading to growing vacancy rates. This is not good news, and the company has made it very clear on their past conference calls that they will face a slowdown in growth in the near term. But I don't think that this is as big of a deal as the market make it seem to be, because this is still just a temporary issue. Typically times of oversupply are then followed by times of undersupply because developers get burnt, they lose money, they stop new construction activity. Already now over the past year, most new development activity has been put on hold because interest rates surged, construction cost was way too high, and so it wasn't economical to build new properties. So this means that I think that next year the supply is already coming down quite significantly, but we still have quite a bit of new supply coming in 2025, but going to 2026, 2027, there will be far less supply, and so the supply-demand environment will be far more attractive for Alexandria, and I think that this will lead to a recovery in its fundamentals. So yes, 2024 and 2025 are going to be more challenging years than usual for Alexandria, but even here the REIT is quite well protected because, again, as I mentioned earlier, its leases are quite long. They have more than 6 years left on average on them. It enjoys steady rent escalations as well of 3%. And then finally, currently its lease rates also below market level, and so that provides additional margin of safety. If you look at its occupancy rate over the past few years, it's been steadily at around 95%. Even this year it has held up or even slightly increased so far, so clearly the company is not doing nearly as poorly as its share price seems to imply. So the takeaway here for me is that Alexandria is a blue chip REIT with very attractive long-term prospects, but it's priced at a bargain valuation because of temporary concerns. However, in just 1 to 2 years from now, the situation will be a lot more favorable to Alexandria because interest rates will be a lot lower. The debt market is pricing about 200 basis point lower rates in just 1 year from now. And already a year from now, the fundamentals of the life science sector should also improve as all the supply gets absorbed and the demand-supply environment improves. Today, the stock is priced at 12 times FFO. This is far lower than its historical average of closer to 25 times FFO. If we now expect it to just return to 18 times FFO as these fundamentals improve, that alone would result in 50% upside, and I think it's quite realistic. It's not overly aggressive because the company will still be priced at a pretty large discount relative to its historic valuation. I agree that perhaps it was a bit overpriced at its peak in 2021, but I think that today it's too low, and the middle ground is likely what a fair value is, and that will be 18 times FFO. That's 50% higher from here. And while you wait, you're earning a 4.5% dividend yield. That's a dividend that keeps growing, that's well covered, that's perfectly safe in my opinion. And the company is also expecting to grow its cash flow by about 5% this year. So simply the dividend and the growth, you're getting to roughly double-digit total returns. Add to that the upside from multiple expansion, and it could realistically earn 15-20% average annual total returns over the coming many years. And that's very attractive coming from a blue chip REIT with relatively defensive fundamentals. Hey, before I go into the second REIT, can you please do me a huge favor and click the like button? That will help me a lot to keep on growing this channel. Thank you so much. And then secondly, I also want to point out that we have a lot of free research also available at High Yield Landlord, which is my REIT newsletter. This includes a recent report on Alexandria real estate. So if you want to check it out, it's the first link in the description of this video. Okay, so the second REIT I'm going to discuss is called WP Carey, ticker symbol WPC. And this is a bit of a similar story to Alexandria in that it's a blue chip REIT that's currently discounted. So let's do the same thing here and review each one by one: the assets, the balance sheet, the management, the valuation, and the risk factors. Speaking of assets, WP Carey is a net lease REIT just like Realty Income, but there are two main differences here. The main one is that WP Carey is mostly focusing on industrial net lease properties, whereas Realty Income is more focused on retail net lease properties. And the second big issue here is that WP Carey has better lease escalators that are typically CPI or inflation based, resulting in faster rent growth than Realty Income, which has mostly fixed rent escalations of just around 1%. I personally prefer the industrial focus of WP Carey because you might know that there is rapidly growing demand for industrial properties today due to the growing trends of onshoring and e-commerce, and this should put WP Carey in a strong position to grow its rents over the coming years. Okay, so that's for the assets. What about the balance sheet? And here again, there is really no major concerns in my opinion. The REIT has a 35% LTV, which is quite conservative. It's a bit more than Alexandria, but it's still very reasonable. They also have a strong investment grade rating, significant liquidity to take advantage of new opportunities. And something unique about WP Carey that I like a lot is that it has access to debt also in Europe because it's quite active on the European markets, and you probably know that interest rates are a lot lower there, and this is allowing it today to keep pursuing growth opportunities and earn better spreads than it could in the US. Okay, let's next talk about the management of WP Carey, and this one is a bit trickier because there's been some recent controversy about its management, and there's a lot of investors who don't like them because of one recent decision that they made, which was to spin off their office properties into a separate REIT, and this naturally led to lower cash flow, and the management then used this as an opportunity to lower their payout ratio, cut their dividend to retain more cash flow for future growth. Income investors hated this because they felt betrayed by the management management in a way, and so they end up selling the stock. And to this day, every comment section about WP Carey is quite negative. You'll find these income investors complaining that the management did them wrong and that they don't trust them anymore. But if you think about it rationally in terms of the long-term prospects of the REIT, I think that the management made the right choice. Selling the office properties individually had become almost impossible because there simply isn't any liquidity. There's no market for these assets because investors know that many of them will face significant vacancies in the coming years, and so there's really no equity value there. You know, if you have a single tenant net lease office property and the lease term is 3 years, and you know that in 3 years the tenant is likely to vacate and you're gonna have to reinvest significantly in the building to potentially release it, it's very difficult to sell these assets, nearly impossible. I used to deal with some of these during my private equity days, and that's the reason why we tended to avoid these properties. And so the management knew this, and so the easiest way to rip off the band-aid and get rid of these assets the fastest and most efficient way possible was to spin them off into a different REIT. And yes, you can blame them for not doing it earlier when valuations were a bit higher, but it's always easy to criticize in hindsight, you know. Overall, I still think that the timing today was relatively good. It would have been even worse if they did it later. And importantly, now they get to restart with a strong portfolio with lower leverage, a lower payout. The other option would have been to just hold on to the properties, but that wouldn't have been better because that would have meant that they suffer growing vacancies in the coming years. They have to use a lot of their cash flow to reinvest in those properties. That would have likely also led to a dividend cut, by the way, just further down the line, and it would have hurt their market sentiment for much longer, potentially a decade or two to come. But yeah, getting rid of these assets right now, ripping off the band-aid, will allow them to now restart from a stronger foundation. Now they are left with their best assets, mostly industrial properties, a lower payout ratio, lower leverage, and now they're in a strong position to reinvest in growth. And so yes, they probably knew that this will hurt their market sentiment in the near term, but if you now look 5 years out, I think that most investors will have forgotten about it. And I would point out that ignoring this one recent setback, the company has actually done exceptionally well of their multi-decade track record. They've outperformed REIT indexes very significantly. They've even outperformed the S&P 500, and you don't achieve such a multi-decade track record of outperformance by accident. This is a REIT that's very well managed in the best interests of long-term oriented shareholders. Okay, so once again, we established that the REIT has great assets, strong balance sheet, a good management team that's long-term oriented, shareholder friendly, despite all the recent controversy. And despite that, essentially the REIT is stronger than ever, but today it's priced at one of its lowest valuations in its history. Its shares are down significantly, and as a result, it's today trading at just around 12 times FFO. This is a low valuation for a net lease REIT, but especially so for a REIT that owns mostly industrial properties. And I think that this is a great opportunity because I think that all these disgruntled income investors will eventually forget about this dividend cut. And if you look back now, 10 years from now, the focus will be completely different. An interesting comparison I think here is EPRA Realty, which cut its dividend in 2011, if I remember right. And then in the next 10 years, the REIT was actually the most rewarding in its property sector because it started from a very low valuation and it built off from there. And I think that there are some interesting parallels to WP Carey today. Right now it's hated, its valuation is low, but it's actually in a better position than ever to grow from here. And as the REIT now proves investors wrong and starts to grow its cash flows, grow its dividend again, its market sentiment might not improve in 6 to 12 months from now. I cannot predict when it will happen. It may take a few years, but eventually I think that it will improve and the REIT will re-rate at a multiple that makes more sense based on the fundamentals of the company. And I think that will be closer to 16 times FFO. That will result in about 30% upside from here. While you wait, you're in a near 6% dividend yield. I think the REIT should be able to grow its cash flow by about 4 to 5% annually over the long run on average. And so again, here you have a similar scenario as Alexandria real estate. I think that the upside is a bit lower here, but you're getting higher yield to compensate you for that. And so the risk reward is very attractive in my opinion in both cases because these are defensive REITs and yet they still offer very attractive return potentials over the long run. I just noticed that I forgot to discuss the risks. So what are the main risks of WP Carey? And I think that it is that interest rates remain higher for longer. I don't think that this is the case. The debt market is very clearly expecting significant rate cuts in the near term. But if interest rates were to remain higher for longer, one tricky thing for WP Carey here is that its debt maturities are relatively short compared to Alexandria. Its balance sheet, as I mentioned earlier, is still in good shape. It's investment grade rating, but it would likely lead its cash flow to stagnate over the coming years as it has to steadily refinance its debt at quite a bit higher interest rates. So that's the main risk here. Now let me know in the comment section below what REITs you're buying following this recent rally. What REITs do you think remain very attractive today? And I think that WP Carey and Alexandria are two good examples of that, but I know that there are many others, so let me know in the comment section below. And otherwise, if you could please click the like button and subscribe to the channel, that will help me a lot to keep on growing. Thanks so much and see you at my next one. Bye bye.